How does raising interest rates control inflation? That's actually the wrong question to ask. The right question is, how does raising interest rates control demand? Answering that question will lead us to understand why inflation tends to come under control as interest rates rise. We first need to look at what causes inflation in the first place. Inflation, namely demand pull inflation, is the byproduct of too many dollars chasing too few goods. In other words, consumer demand for goods exceeds the available supply of those goods, leading to an increase in prices. That's exactly what happened when worldwide lockdowns ended in 2021. What you had was a population with record levels of savings as they were unable to spend those savings during lockdown, leading to pent-up demand. This was further assisted by global central banks reducing interest rates to zero to encourage spending, and by the issuance of stimulus checks to supplement any potential loss of income during the pandemic. However, on the supply side, you had a global supply chain system that was fundamentally broken as a result of the pandemic. All of these factors contributed to the mismatch between supply and demand, which resulted in the initial bout of inflation post-lockdown. The already bad inflation was worsened due to Russia's invasion of Ukraine, which sparked a global energy crisis. Higher energy prices resulted in household and corporate energy bills going through the roof, in addition to widespread price increases wherever the energy pinch was being felt. All of this culminated in inflation rates which had not been seen for over 40 years. Whenever inflation gets out of control, all eyes turn to global central banks because it's their responsibility to ensure that prices are stable within the economy. This is where interest rates come in. Central banks are able to increase or decrease rates as they see fit, depending on what the economic circumstances call for at that given point in time. Whether they choose to increase or decrease rates will depend on what they want demand to do. If they want demand to increase, they would decrease rates. If they want demand to decrease, they would increase rates. That begs the question, why do rates influence demand? Rates set by global central banks directly impact the cost of borrowing money. When rates rise, it becomes more expensive to borrow money, meaning less businesses and individuals are able to do so. This results in less money circulating in the economy, and therefore less demand. It also impacts the cost of borrowing for those who have already borrowed money. Think about the average household with a mortgage. If rates rise, anyone with a variable rate mortgage is going to experience an increase in mortgage repayments. That means they'll have less money to spend elsewhere on a monthly basis, i.e. they'll have a lower demand for goods. So that's the key. Central banks change rates in order to control demand, not inflation itself. The act of controlling demand is what may lead to lower inflation over time. The reason why I say may lead is because increasing rates isn't an instantaneous fix for inflation. Central banks have no control over the supply side of the inflation equation. In other words, they can't control supply like they can control demand, and both factors influence inflation. Central banks have no control over energy shortages or supply chain breakdowns, both of which can result in higher prices even with rising rates and falling demand. So depending on how high demand is and how low supply is, it may take many rate increases before inflation starts to fall, which is exactly what we're seeing at the moment. The higher rates go, the greater the risk becomes of a recession. If you want to hear how a global recession in 2023 would impact you, check out the video popping up on screen now. I'll see you soon.